Hello guys, welcome to the first video of our stock selection series. In this video, I am going to give you a tool of one of the most useful websites, that is Tickertape.in, which is helpful in selecting stocks based on the fundamental analysis of the company. So without wasting much time, let's go and deep dive into the website. So we have to log in to Tickertape.in, and this is how the website looks. Here all the prices of the different company stocks are seen on the top. We have to go to the screener button, which is present in the middle of the page. If you have an account with any of the broker, you can log in through this login button. I have already logged in through my broker. So let's go into the screener button. So this is how the screener looks like. Here we will create a new screen, and in this new screen we will select the stocks that we want to filter out from the number of stocks based on the fundamental analysis. So I have already created a screen based on various filters. I will explain each one of the filter one by one. So let's go to the first filter, that is the PE ratio. The PE ratio is the price to earnings ratio. It tells us about how much the investors are willing to pay in respect to the earnings which are posted by the company. The general metric for any of the stock is that an undervalued stock has generally a PE ratio of less than 30. So I have taken a range of PE ratio from 0 to 30 so as to filter out the most undervalued stocks which are presently trading in the stock market. Now coming to the next indicator or the ratio is the ROCE. ROCE stands for return on capital employed. Return on capital employed means that how much the company is able to generate out of the total capital that the company has. The total capital includes the capital from the equity as well as the capital from the debt. The general metric for the company to have a good return on the capital is to give a return of 10 to 40%. You can increase more depending upon your choice of the company, but I have taken a range from 10 to 40 as a general ratio. Coming to the third parameter is the debt to equity ratio. The debt to equity ratio explains how much does the company takes leverage per times of the equity capital that the company has. So basically there are two modes by which the company can take capital. One is the debt and the another is the equity. So the higher the debt to equity ratio means that the company has taken more loans as compared to the equity capital, making the company more leveraged and more risky. As a general mark, I have taken the debt to equity ratio from 20 to 60. You can lower it down if you are a conservative investor, and if you are a high risky investor, you can increase this percentage to even up to 80 and 85. Companies with debt to equity ratio more than 100% are considered very high risk companies, and investors should take clear guidance from their financial advisors before investing into such companies. The next metric is the 5-year historical EBITDA growth. EBITDA. You must have seen a company financial statement. In that statement, EBITDA is the first parameter which is discussed for the growth of the company. EBITDA stands for earning before interest, taxes, depreciation and amortization. We will not go much into the depth of the EBITDA and how it is calculated, but on a basic sense, EBITDA is the overall gross profit of the company that it makes after subtracting the operating costs of the business and the general cost that the company incurs for the day-to-day running of the business. I have taken a general metric of the 5-year EBITDA growth from 5 to 50%. You can increase it up to 60 or 70 depending upon your choices of the company. The next parameter is the 5-year historical OCF growth. OCF or CFO stands for the operating cash flow. This signifies that how much cash does the company is generating and how much cash the company is getting in an overall year from the operating activity, that is the main and the primary business activity of the company. I have taken the range of again 5 to 50 as the growth of the cash flow from the operating activities for a 5-year historical time frame. The next parameter is the price to book ratio. Price to book ratio stands for the how much times does the price of the company at present is trading as compared to the book value of the company. The book value of the company is that value of the equity which is calculated after subtracting the liabilities of the company from the current assets, from the overall assets of the company. I have taken the range from the price to book ratio as 0 to 6. The lower the price to book ratio signifies that the company is highly undervalued and has a very high chance in reaching up to a higher price or a higher value. Now, based on these filters, the screener generates a result of almost 72 stocks. This list can be increased or decreased by changing your ranges of the different parameters. For example, if I just change the debt to equity ratio from the maximum limit of 60 to 80, this result changes from 72 to 93, thereby increasing those companies and adding up to those lists who has the debt to equity ratio from 60 to 80. So I will reset from 80 to 60. And again, we are back to the original list that we had generated of 72 companies. So now this screener helps you out in sorting the favorite companies based on their most important fundamental statements and their financials out of a number of companies which are trading on the exchanges of National Stock Exchange and the Bombay Stock Exchange. If you want, you can add more filters to this list, but adding more filters will make you more confused in selecting stocks. Thereby, my advice is to keep the number of filters as low as possible so that you can select the stocks easily out of the given filter choices that you have taken. Now, how to select the stocks out of this list for your investments? The first criteria is to have a debt to equity ratio. So we can sort each of the columns one by one to see which of the companies that you are interested in investing. If we sort from the debt to equity ratio from descending to ascending, we see the first company that comes at the top with the maximum debt to equity ratio is the Prima Agro Limited. Now one can see this debt to equity ratio as among the highest of all the companies that we have sorted out. So our prime objective is to have a debt to equity ratio as the lowest of all the companies. So for the sake we have taken 20 as the minimum value. Now if we sort with ascending order, we see the first company that pops out on the list is Heidelberg Cement Limited. Now we will see all of the ratios of this company to see if the company fits into our investment goals or not. So if we start from the first value or the ratio is the PE ratio. So this is 14 of the company. So 14 means that investors are expecting and they are ready to pay 14 times of the share price as compared to the earnings that the company posts per share. This number is pretty good and it is highly undervalued. The next is the ROCE. ROCE of 23% is a wonderful return generated by the company on the overall capital that it has. So again, this gives a buy selection for this stock. The third parameter is the debt to equity ratio, which is 20%, which is also fine. The next is the 5-year historical EBITDA growth, the 17%, which is another wonderful sign for the company. The same is the operating cash flow, and the price to book ratio is almost 3, which signifies that the present value of the company is 3 times to its book value. So based on these selections, Heidelberg India Limited, which is a company in the cement subsector, looks a top-notch choice for investing into the company. Similarly, we can scroll out different stocks and choose out of the 72 which stocks you would like to invest. I hope you like this video, and if you like it, please hit the like button and do share and subscribe to our channel. Thank you very much.